For 2024 this year, I was looking to add some stability to the portfolio that would provide a consistent rate of return similar to the S&P 500 index, but also with covered calls to provide additional passive income at the same time. That is a lot to ask for, but there are two ETFs I've been tracking since the start of this year that fit this role and at times might even be able to beat the S&P 500, at least from the two comparisons I'll be going over in this video. Okay, let's get started. So the focus of the portfolio is on dividend-paying stocks or ETFs, and to eventually be able to live off the passive income that is generated in the future. But in the meantime, while I don't need the dividends, I would like for the additional passive income to speed up the growth of the portfolio by reinvesting all the dividends for more income and growth to start the compounding effect. Just like how many investors invest in broad S&P 500 index funds, I think there's a place for that in a dividend-focused portfolio as well, to provide that stability and growth while also getting a steady income at the same time. While having a position like this being the core of your portfolio, it would also help mitigate some of the more riskier plays you might have smaller positions in, and lower the impact if those don't work out. So the first of two ETFs I'll be comparing is one of the largest and most popular covered call ETFs in Canada, and that would be HYLD. It's just recently passed over 500 million in AUM, and I've had this holding for almost 2 years now. Then the other ETF I've added recently to the portfolio in December is USCL, which is a newer fund but has been growing steadily in popularity. For this video, I won't get into the details of each of the funds and their individual strategies. I've already briefly mentioned them in previous videos, but if that's something of interest to you, let me know in the comment section below. For this comparison, I'm going to start from the beginning of this year, and that's because a lot of the recent changes HYLD has made to its holdings were completed between December and February of this year, so its performance before this period are no longer relevant to the performance going forward. The main reason for wanting to track this is to confirm for myself that they are going to perform as intended before making them a more significant portion of my portfolio. Each one is currently between 8 to 10% of my portfolio right now, and I'm liking what I see in the performances so far this year. I'm going to try and keep this very straightforward and as simple as possible, and in a way that you can do it for yourselves as well if you wanted to. The first comparison I'll make is purely based on the stock price, simply which one has performed the best year to date so far, and you can literally use Google to find this information. The second comparison isn't much more sophisticated, and is just simply adding the dividend distributions that have been paid out to shareholders back into the fund. This is because when the ETF pays out a dividend distribution, it comes from the fund's earnings being transferred to its shareholders. So by adding back the dividend distribution, it'll give a sense of what the total return would look like if those earnings were retained. You can visually see this occur in the charts, where there's a steep drop in the stock price of the ETF on the ex-dividend dates, because that's when the ETF begins trading without the dividend that is to be paid out. If you compare it to the S&P 500's performance that day, it either stays flat or moves up on those days, so you can clearly see the divergence happen as a result of the distribution being removed from the price. Now to show you where these numbers came from and how you can also do this on your own, I'll summarize the process of creating these charts so you have a better understanding in case I've missed something. To start, I found the specific pages for USCL, HYLD, and the S&P 500 on investing.com to get the historical prices starting from January 1st of this year until today. Once I apply the date range to the filter, I downloaded the data and then went into Google Sheets to put each of them into their own individual tabs. But before we do any calculations, I want to make sure that the dataset was complete and that there wasn't anything missing. What I found was that the S&P 500 dataset was missing a record for January 15th, and I figured that the stock market was probably closed in the US for a holiday while the Canadian market stayed open. It turns out that it was Martin Luther King Jr. Day that closed the US markets, so I simply added another row and noted down a 0% change. Next, I wanted to simply verify the dataset with another source and make sure that these numbers I'll be using were correct and could be trusted. I went ahead over to Google and looked up each stock individually to verify the most recent day's change in price, and surely enough, all of them, at least from the current day, matched up exactly. There were a few small instances of discrepancies when I checked some of the other dates, but for the most part, these numbers were overall fairly accurate. Now with all that completed, I went ahead to add some formulas to do some simple calculations. Firstly was to get the running total for the year-to-date performance, as the current data only shows the change percentage for the price of each day in relation to the price from the previous day. All I had to do was to sum together the change percentage column from all the previous days, and it would then give me the aggregate total for the year-to-date performance. Now again, to verify these numbers, I headed over to Google to compare the year-to-date values for all three of them. We can see that in this instance, none of the values match identically, but are not wildly out of line where the results would be invalidated. And with just this alone is all we need to create the first chart comparison. Now for the second comparison I've already mentioned, we'll just be adding back the dividend distributions that were removed on the ex-dividend dates. So to do this, I created a new column for where the distribution amounts will be inputted, and then filled in the values on the ex-dividend dates for each ETF. Then the next column I added is the new change percentage column, where it should look identical to the existing one, except for on the ex-dividend dates where the distribution was re-added back into the price. We can verify that the math is correct by comparing the other values outside of the ex-dividend date and making sure they are matching identically to the existing values. With all that being correct, all I need now is just an updated column of the running total for the year-to-date performance, and that's going to be exactly as I did in the first comparison, where I sum up the change percentage column from all the previous days to get the aggregate total. Now the calculations are all done, and we can then create the second chart comparison to finally begin looking at the results. From looking at the first comparison for stock price, USCL has been able to show that it can have periods where it's able to outperform and stay ahead of the S&P 500. But I don't think we can conclusively say that one is outperforming the other at this point in time. For HYLD, we can see some consistency since the start of February, where it has lagged behind the S&P 500 index, but we haven't seen a strong divergence of performance yet, though one might be happening with this recent pullback in the market. Overall, both the ETFs have been tracking the index quite closely and have maintained similar performances so far this year from a stock price point of view, while also providing an 11 to 13% dividend yield at the same time. When now looking at the comparison with distributions included, we can see a different story, where both USCL and HYLD have maintained an edge in performance and have stayed above the S&P 500 for most of this year. Looking at just USCL's performance, it's clear that it has stayed ahead of the S&P 500 when the distributions are retained in the fund, and that there hasn't been a point yet since the beginning of the year where it has dipped below the S&P 500. As for HYLD, it has stayed more closely aligned to the S&P 500 and was starting to see some separation, but that gap has now been closed and is back to being on par with the index. So we'll just have to wait and see where it goes from here. So has this been able to determine if it's possible for covered call index funds to track the S&P 500 while also paying a 10% plus dividend yield at the same time? It's too early to tell, as we've been somewhat of a bull market since the start of the year, and with this recent downturn, we'll be able to see how these will perform on the downside, and then eventually how it will recover when things go back up. What's been interesting though, and has been a majority of the complaints against covered call ETFs, is the gradual decline or NAV erosion in the price over time, where you lose your initial invested value due to the dividend distributions that are paid out. But so far through 3 distributions, we've seen the stock prices stay closely aligned with the S&P 500 and even beating it through some periods despite the steep drops on the ex-dividend dates. For myself, these funds have been performing very well, and they're probably the 2 holdings I worry about the least in my portfolio. Also, what to keep in mind, one thing that isn't shown here and would lean the performances of these ETFs slightly more towards an outperformance is the reinvestment of dividends. So if we instead had taken the dividend distributions from USCL and HYLD and then reinvested it by buying more shares, then over time this would start a compounding effect to provide even greater returns each and every month. And to showcase that, I built a very simple tool where you can create projections from any dividend paying ETF or stock and calculate what your returns might be in 10, 20, or 30 years from now if you continue to reinvest the dividend. This will be completely free, and I'll create a separate video for it where I'll go over how it works and how you can use it. So if you'd like to be notified when it's released, feel free to subscribe and give a like on this video to help out the channel. Let me know your thoughts on these comparisons in the comment section below, and if I should continue tracking the performances of these 2 ETFs for the rest of this year. If you want to take a look at the data and the charts for yourself, I'll leave a link in the description to the spreadsheet. Thanks for watching, and I'll see you in the next video.